Good morning once again, and welcome to the Haven Financial Group radio show. Thanks for listening. Feel free to give us a call at 612-504-8400 or visit us online at havenfinancialgroup.com, where every week we talk about these crucial retirement topics, these puzzle pieces. Do you have all the pieces? Do they go to the same puzzle? And it is winter. Many people are doing puzzles. Maybe this is a puzzle that you should be doing this year in 2026. Pitfalls. This segment, we're going to talk about pitfalls, what to avoid in retirement. And we want to avoid all these pitfalls we possibly can. And we see these so often, a lot of people don't avoid them. And many of these can very much be avoided.
Well, I love the first one because this is one I have to talk to my husband about, because he's a guy who believes he's going to work forever. And the idea of planning to work indefinitely is not really great.
No, it's not. What we see here is, life doesn't always cooperate with our calendar. Health plays a role. It certainly does. And oftentimes, health interrupts our work. And when we think we're going to retire, isn't always the case. In fact, statistics show that people have an idea of when their retirement date's going to be, but oftentimes it's earlier than they anticipate for health reasons, or maybe that pink slip comes your way and you weren't planning on it. Maybe they're outsourcing to a different country, which we've seen obviously in recent years, whatever it may be. So plan accordingly. It doesn't always go the way you think it's going to go, for sure.
Mm-hmm. Avoiding the stock market. I think a lot of people, when they get into retirement, Kyle, they just say, and you've said this many times, they say, I'm getting all my money out of the market. I'm not doing that anymore. I can't run that risk. That's not really your best, probably for most people, your best avenue to take.
No, and you want to have a good balance, and maybe that means taking some stocks off the table from your portfolio. So maybe you're at 70% stocks while working, and then we get into retirement and we want to lower that to like 40 or 50% stocks. It just depends on what your appetite for risk is. Sure. And before retirement, we're in an accumulation phase. And then once we get into retirement, we're kind of in a phase of just not wanting to make any errors, right? We have the NFL playoffs coming up, right? And the teams that typically win the Super Bowl, they don't make errors, right? You don't want to have turnovers. And that's exactly what we're trying to do in retirement, is we're just trying to preserve with a best mix that we can between stocks and bonds that we can to maintain our lifestyle as close as we can from before we were retired, all the way through retirement. And we plan all the way until our mid 90s, just because we want to plan for longevity as well. Because if you underestimate how long you're going to live, that can also lead to problems.
You bet. We talked about this in the segment before the break, of course, claiming Social Security too early, leaving money on the table, right, Larry?
Yeah, leaving money on the table. We talked about that last segment. And I want to piggyback off what Kyle just said. The NFL playoffs, we don't want people to avoid the stock market. We do wealth management with Fidelity and Charles Schwab. We're not against the market. But what we find is people are unaware of how much risk they're taking, and they should have an awareness. Right place at the right time. You're not 20 or 30 anymore, right, when you can take more risk, because the longevity is on your side. You get closer to retirement, not so much. So minimizing that, stress testing that portfolio. Defense wins championships. It does. Now, I'm not saying you should put it all on the sidelines, because people try to time the mark, they get out, and then they don't ever get back in, and they miss opportunity. But I will say, being more defense does win the championships. Rebalancing. Kyle can address this. We're not against people doing investments themselves. If you're a do-it-yourselfer, that's fine. If you are a do-it-yourselfer and you're married, make sure you have a backup plan for that spouse, that a relationship has been kindled somewhere. So if you're not here, you have somebody where your spouse can go to comfortably. And again, Kyle can attest to the rebalancing, if you will, Kyle, what the opportunities people miss out on by not doing that.
Yeah, absolutely. I mean, if we just take 2025 as an example, there were 2 times where there was major rebalancing potentials, right? In April, and then also in November, early December. So the market had some dips there that if you weren't rebalancing, you missed out on great opportunities to buy at what we call lows or discounts, right? So the market rebounded very well in each of those times. And, there's stats out there that 90% of market rebounds happen within like 2 weeks of when the initial the worst day was in a down market, right? So that's rebalancing impact, is buying when that dip happens, so then you can recover well when it does come back, because the market's never not come back. So we just want to stick with our academic research there and stay consistent again.
Sure. We're talking about pitfalls in retirement and some of the things that you definitely want to try to avoid and can, if you're aware of them and you start planning. These sort of, to me, almost go hand in hand. Ignoring long-term care needs and at the same time miscalculating your retirement income needs. Long-term care is part of your retirement income needs, correct?
Yes, we want to plan accordingly. This is a big one. Nobody wants to talk about the nursing home or long-term care. Who does? Nobody does. None of us do. But guess what? Statistics show that 70% of us are going to need some sort of care. And many of the listeners have heard of, the old Cadillac long-term care plans that nobody in their right mind could afford anyways, and you got scared away from it. I get it. But there's much better viable options that are on the open market today, such as hybrid long-term care plans or asset-based long-term care, much more viable options. And if you've been avoiding this conversation, or you got scared away by some sort of Cadillac plan years ago, or maybe you think you're too old to get long-term care, that's not necessarily the case. Give us a call. Come on in and visit with Glenn or Isabella. We help a lot of people in this area. It's going to be a focus on our clients in 2026 to make sure that we at least having the conversation. What does that entail? What does your situation look like? Address your income needs, not only for the income needs for the things you want to do in retirement, the things you need, but the things you want, the lifestyle. And also we factor in long-term care. In the Twin Cities here at $12,000 to $15,000 a month, it can decimate even a very healthy investment portfolio or an estate. So maybe you're listening and go, well, I'm self-funded. Well, maybe not, but maybe there's a better way to fund it without having to use all of your own money if you do go into a nursing home. And if you're a married couple, statistically, men, we go first. Not always. What position does that leave your surviving spouse in? Who's going to take care of her or him when the first one goes? So we can avoid this conversation all we want, but it doesn't get us anywhere. And I can tell you, if you've been through this with a parent or a loved one, you know exactly what I'm talking about. You know exactly. So let's start with a conversation. It's all where it starts. And let's see, is there something better we can do without trying to get the sold a bill of goods? Because that doesn't do anybody any good either.
Absolutely. Well, it seems to me that these pitfalls are things that you want to try to avoid if at all possible, because they can make the difference between surviving and thriving in your retirement, right?
It really can make the difference, and we're starting off a new year, whether it's tax planning, tax preparation is right around the corner, and Lance, our CPA, and Melissa, maybe you want to take a closer look at that. Maybe you want to address your healthcare needs. Maybe you want to address the long-term care discussion that I just talked about. Maybe you're not getting the attention on your investments. You have no idea how much risk you have in your portfolio. You have no idea what you're being charged. I can't believe how often we ask the question, what are they charging you to manage your money? And oftentimes it's two to three times the going rate in a competitive industry. Nothing's free. I get it. But there should be transparency. It should be expected. Or maybe you're listening and go, you know what? I've been talking about putting a will or a trust together for 25 to 35 years. How about you put that to bed and actually get it done in 2026? Giving the family and your loved ones peace of mind to know whether you have a lot or a little or anything in between, we've done the best we can to protect our hard-earned money that we work for all these years. Again, let's make 2026 a wonderful year, but let's accomplish something.
Mhm. So give the folks at Haven Financial Group a call. The number is 612-504-8400. That's 612-504-8400. Start the year off right by joining together with a partner to make sure that you avoid those pitfalls and that you begin planning a retirement that you've always dreamed of. Larry and Kyle, thank you guys so much. Happy New Year to both of you.
Great to be with you, Kim. Happy New Year as well to you, and cheers to a blessed 2026.